Well, hey, everybody. Welcome back to the channel. In this video, I'm going to talk to you about buying calls and puts versus selling calls and puts. There is a difference, and I'm going to do the best job I can to make it real clear to you what the differences are, as well as the similarities. And if you hang out with me till the end, y'all know I always have a treat at the end. I'm going to go through a stock that we use every single day to generate 10% returns as a seller. All right, let's get into the video.
We're going to look at some stuff today, and I want you to know, first off, I'm going to cover what are calls, what are puts for buying and sellers, for buyers and sellers. After I talk about calls and puts and what those are, I'm going to show you what we do on a daily basis in order to get this money every single day. So what are options? Options are different from shares. You buy a share of Apple, you buy a share of Amazon, you buy a share of SoFi. That's my darling. You buy a share of these, you get one-on-one, and you are an owner. You have an asset of something. You own a share of the company. So you're a part owner of that company when you buy a share. When you're buying an option, though, when you're working with options, not just buying them because you can sell them too, but when you're working with options, you are working with 100 shares. You have the right to do things. It's an options contract. So it's a piece of paper, or it's not even paper anymore. It used to be paper back in the day. Now it's electronic. You have an electronic option, which gives you the right to do something with this 100 shares of that stock at a particular strike price, at a particular expiration, all those things. Right. It gives you leverage. So an options contract is for 100 shares. That's what I want you to get out of this. One options contract is for 100 shares. It gives you the right to do something with the 100 shares, not just one share. When you're buying shares, you're buying the 1, 2, 3. You're buying onesie at the price that they cost. When you're buying or selling an options contract, you're working with whatever the price of that particular contract is at the time that you are buying or selling it. All righty. That's the difference between shares and options contracts. Options contracts have expiration dates. They work with strike prices. When you're buying a call, you have the right to buy shares, the 100 shares, at whatever strike price you've selected if the price goes higher than that. If the price goes higher than that, you have the right to buy the 100 shares at that price. So let's say you have a call contract and you have a 100 strike price, which means you're saying at the 100 price point, I will buy 100 shares for $100 a piece if it goes above $100, right? That gives you the right. Most people don't exercise the right to buy the shares. Most people take the money. You say, I bought this call contract and it's going, and the profits now are $300 or whatever your profits happen to be. Most people close it out and take the money. They don't want the shares. Most people don't. Some people do, because I think I saw one time Kathy Woods bought some shares somewhere, or she had call contracts, a bunch of them. And when they got in the money, she exercised the right to buy them at that price. The reason you do that is, let's say you have them at $100 strike price, but they've gone up to $110 or $130. If you buy them at 100 and they're worth more than that, then of course you're buying an asset that already comes with value. That's why you get that in the money. That's when you're buying a call. Generally, you're expecting price to go up. This is a long move or a bullish move. Most people just, when they get in the money on those, or they get where they're in profit, they take their money off the table. If you're selling a call, though, selling a call is the opposite of that. You are saying, at this strike price, I'm willing to sell 100 shares at this strike price, whatever that strike price happens to be for your selling contract. And for the right to do that, or for me to sell this contract, I'm going to collect a premium while I'm doing that. I'm saying I'm willing to sell 100 shares at the $100. Let's use the same $100 strike price. I'm willing to sell 100 shares at the $100 strike price. If the price goes above that, and somebody like a Kathy Woods exercises their right to buy them at 100, My sales contract says I'm going to release my 100 shares at that price, right? You're going to sell what that's called a covered call. Usually when you're selling calls, it's usually called a covered call. Some people, depending if you got a lot of money, you can sell naked, which is called, you don't have to have a cover, but you got to have the money in your account to withstand the ability to sell somebody something that you don't already own. So you're going to have to buy it and then sell it to them. That's called selling naked. We don't do selling naked in my community. We do covered calls, which means we own our 100 shares, or you're using a long contract and you're covering that. That's called covered calls. That's when you're selling calls, and you collect a premium when you're selling calls. All right. You're collecting a premium when you're selling calls. Okay. So that was calls. You buy a call, you're expecting price to go up. You can take the money, or you can buy the shares at the price, at your strike price, if that's what you so choose. You want the trade to get in the money, or at least get in profit so you can get your money. That's when you're buying a call. When you're selling a call, you're really going above the current price, and you're saying, I'm willing to release or sell 100 shares at this place. While I wait for this to happen, I'm going to take in a premium. If the price goes past my strike price, I'm going to release 100 shares to whosoever has decided to buy, right? That's called selling a call. You buy a call, you sell a call. They're opposite. You're expecting, when you're selling a call, you're expecting the price to stay below your strike price, either to go down or at least stay below your strike price. Doesn't have to really go down. You're just expecting it to stay below your sales strike on your covered call, and you're going to collect money. It's a way you can do, people use it for income. Use selling covered calls for income. All right. So we talked about calls. Let's move on to talk about puts. Puts work a little bit different. Some people get confused when we say we're going to do something with puts. It's like calls people can easily get. We're used to stuff going up. When it goes up, we expect more money. Most people don't have a problem understanding how to work with calls. Working with puts is a teensy winch difference.
Well, hey, I want to thank you for hanging out with us. Thank you for watching the video. Please sure to like and subscribe. Subscribe to the channel. Click the notification bell so you can make sure you get notified every time I post any new content. And we'd love to see you coming over and hanging out with us.
I don't know if teensy winch is a word, but teensy winch difference. All right. Let's move on to puts. We're going to puts. If you are buying a put, is where you're expecting, if you're buying it, you're expecting price to go down, almost like put down. If you're a buyer, you're expecting the price of the stock to go down when you're buying a put. When you're buying a put, that options contract is saying you are obligating yourself to sell, which is weird now because you're buying a put, but you're obligating yourself to selling. You're saying if I'm buying a put, I'm obligating myself to selling 100 shares at this place, at this strike price under here that I've selected. That's where people get confused, I think. You're buying a put, but you're obligating yourself to sell shares at this lower price, at this price that you have down there, whatever price you selected as your strike price, right? Buying a put, you're expecting price to go down. It is a bearish move. You make money as the price goes down. Price needs to keep moving in order for you to make your money. Of course, when it gets in the money, you can take cash out. Most people take the money. They take the money. Most people take the money. They don't necessarily say, oh, good, I'm down here at this price. I'm going to sell it. Sell my 100 shares. I'm going to sell 100 shares down here. No, that's not usually what happens. People take the money. Take the money, honey. Okay. But when you're selling, it's an opposite. The opposite. When you're selling, it's the opposite. So when you're selling a put, what you're saying is prices in a spot. Let's say prices right here. You're selling a put below the price. So from that standpoint, it is still down. You're selling a put below the current price, and you're expecting the price of the stock or the equity to stay above your strike price. You're expecting price to stay above that strike price when you're the seller of a put. You collect a premium When you do the selling of a put, you collect premiums there. Anytime you're selling, you collect a premium. I want to make sure that that sticks in your head. When you're selling, you collect money. When you're buying, you have to pay money. Just like in real life. If you're buying something, you got to pay for it. If you're selling something, they give you the money. Same thing with the stock market as far as options go. Yes, yes. Okay. If you're selling a put option, you're selling it with a strike below the current price, and your thought is that price will stay above your strike price. That price will stay a little bit above you. You're going to collect a premium with that. But if the price comes down into your strike, if your strike is quote unquote breached, yes, if your strike is breached, that says you will buy. Even though you're selling puts, you're saying, I will buy 100 shares at this price. Because if you're selling a put, if the trade doesn't go the way you want it, they're going to put 100 shares into your account. Okay, the broker don't need no permission, and no, he's not going to send you a notification going, do you mind if we put these 100 shares in your account? Nobody's going to ask you that. If the price is down there and it's past expiration, or you get exercised, the sign, I think it's called a sign down the put side. If you get assigned your 100 shares, the broker is just going to put them there. The broker's going to say, oh, you did a put contract saying that you were willing to sell these, or willing to buy, sorry, these 100 shares in this area. So here you go. Here you go. So let's reiterate puts. If you're buying a put, you're expecting the price to go down. You're expecting the price to go down. It is a bearish move, right? You're expecting price to go down. If price goes down, or as price goes down, you have the right, as the person who owns the put, to sell your 100 shares at this price. You have the right to sell them, to sell 100 shares there. As a seller, as the seller, you're getting your strike price below current price. You're getting your strike price below the current price, with the anticipation that the price will stay above your strike price. But if it doesn't, you will be put 100 shares into your account. Well, you don't have to worry about that part, because when you open that selling a put trade, the broker is going to block off the money to pay for those 100 shares. Why would people sell puts? You got to think about, why would they sell puts? Well, one of the main reasons why people sell puts is because they want to buy stock at a lower price. If Amazon is currently, it's not, but if Amazon was at $100 and the person said, I like it at $100, but I'd rather buy it at 90, they would sell puts at $90. And if the price comes down to the 90, they're saying, okay, I'm willing to buy 100 shares at $90. That's why you would sell a put. You sell puts when you're wanting to buy shares at a lower price. That's when you sell puts. That's when you sell. Now, I'm trying to make sure my words stay separate, because when you're buying puts, it's something different than when you're selling puts. All right. Buying and selling are definitely opposite things. They're opposite things. But as sellers, we take in the money. We take in the money. So while I'm waiting for the price to come down, or potentially down to where it's going to be, I'm making premium. So some people sell puts just for income. Everybody who's selling puts doesn't want to acquire the shares. Some people are selling puts solely for income. They say, okay, while I wait, I'll just make premiums from selling puts. And if I happen to be given or put the shares in my account, then I will just sell covered calls on that same stock. Okay, so selling puts and selling covered calls is what's called the wheel. And if you've ever heard of the wheel strategy, the wheel strategy includes selling puts. Then when you get the shares, then you sell covered calls. Then they get called away. Then you sell puts again. And it's a wheel. It's a circle, right? Those are those two things that are going with that. So we talked about calls, buying and selling calls. We talked about buying and selling puts. Now, I've narrowed it down to a very, very basic thing with options, right? I've brought it down to the bare bones, because options includes all kind of stuff. I told you expiration dates, strike prices, you're incorporating deltas. Options, you can go deeper and deeper. You can go deeper and deeper into options knowledge and options learning. Definitely, right? So if you're selling puts, the wheel is when you sell puts. If you end up with the shares, then you sell covered calls at a price, higher than your cost basis for how much you paid for the puts. And then if they get called away based on price going up, then you sell puts again on the same thing or on something else, all in what you want to do. Some people solely sell puts on different stocks, and they just run this wheel over. That's their whole strategy. The reason I like covered calls and selling puts, of course I'm a seller, so I'm going to talk from the seller side. The reason I like selling covered calls and selling puts is that those two strategies, I call that a no lose strategy. They're no lose, because if you're selling puts and you get put the shares, then you're given an asset. You're given 100 shares to do whatever it is you want to do with it. And if you sell covered calls, as long as you're above your cost basis, if that trade doesn't go quote unquote your way, then you're releasing your shares at a price higher than what you paid for them. So you're still making a profit. So no matter what you do in this wheel, you either end up with shares and premiums, or you lose shares, keep the premiums, and get the extra money. So either way, profits. You always end up on the quote unquote the winning side. Unless, of course, there's one area where this isn't really a bad side. I mean, it's not really like a losing side, but it's just not as great. If you sell puts and the price of the stock just tanks, then you still will own 100 shares. It's just the value of them won't be as nice. You'll still own them though. You still get something. You still will have something. I'm going to talk with you about the different stuff that Educator to Trader has to offer. Okay, so be sure to like and subscribe to the channel. If you have not subscribed to our YouTube channel, please do so. Like, subscribe, click the bell so we can share information about options, specifically as an option seller, right? Specifically as an option seller. So I do talk about it in general, but I'm going to come from the seller side, baby, coming from the seller side. We got that. We've got the membership, E2T membership, where we trade together every single day. We trade together. We hang out together. Everybody finds their trades. If they got questions and comments, then we do that together. Every couple of weeks, we do coaching calls. We do live trading. We play a cash flow game every second Saturday and have fun doing that together. And we're just there really as a community to support one another, because trading can be lonely. My website, http educatortotrader.com. Okay, this is XSP is the mini of SPX. So SPX, if you're doing spreads, there are 5 spreads. So you need at least $500 of collateral. XSP. The reason I like it is because it's only a 1 spread, which means it only requires $100 of collateral minus whatever premiums you take in, but it's a credit spread. So we're looking here at XSP. We've looked at the high of the day, which I marked the high. I've done some support and resistance. The high looks like it's 441.06. And the low of the day is 439.09. This is an afternoon strategy. Some people do it earlier in the day, but you need to do some different, you need to have some different tools if you're going to do it earlier. I'm just going with a simple, straightforward thing here, right? We've got some resistance. We've got some support. Looking for our sell legs. If we're looking at 441, current price though is at 440.76. So when you're selling either calls or selling puts, you do not want the price to go to expire beyond your price. You don't want the price to expire beyond your price. All right. You want your sale strike, whatever you pick as your sale leg, you need that to be, the price needs to stay below that, or it needs to definitely be below that when it comes time for expiration. I want to look at it from a delta standpoint. So if we're looking on the puts side over here to the right, y'all see my mouse. Over here on the put side, we're looking at a delta that is below. I like to stay below 25. It's safer to stay below 15 and 16. So if you were going to go either one of these two numbers, better be safe than sorry. Let's look at 439. We'll see what kind of premiums there are when we do 439. That's on the put side. And if we're looking on the call side, our call side, we said above 441 was where the strike was, where the resistance was, but that 441 strike has a delta of 42. Too high. No, we want to be at this one here, this 12 delta, something that's lower than 0.15 is really better. What that says is that a 0.15 delta is saying you've got a 15% chance the price will go here, but there's an 85% chance it won't. 15% chance, this is right here, this is 11. So 11% chance the price will come up to 442, which means there's an 89% chance it will not. But if you're looking at this smallest delta here for the 441 strike, this is a 41 delta, which means there's a 41% chance it will reach this price at expiration, which means there's a 58% chance it won't. Those aren't the kind of odds I be wanting. The kind of odds I be wanting. You know, that's not good English. So let's maybe look at 439 or 440, and then we'll look at 442. Okay, I'm switching over to vertical. Looking at vertical. Well, at the 439 strike, looking for 439 on the put side, the amount of premiums is only $2. $2, no bueno. It's not enough. You're going to pay $1 some change in fees. So that's not going to buy you anything. We're not trying to trade for trading sake. We're trading for money sake, right? So the 440 would be a better place as far as a strike goes. Prices at 440.79. 440 would be a better place. And if you were to enter this trade, right, the 439, 440 strike price, the vertical, is going to pay $9. $9. You're leveraging 100, subtracting your 9, which means you're leveraging. I'm going to make this a $10. No, I'll make it $10. You know, you can adjust this little price thing here to what you want it to be. I want you to practice this in your sim. Don't be jumping on here doing it live unless you know how to be live. If you know how to be all the way live, then let's do it live. But if you don't, then let's practice it in your paper and in your sim. All right, until you get some learning and get some experience under your belt. I'm putting this here basically saying we're going to do a spread, a put credit spread at 439, 440. We don't want the price to expire below our 440. We don't want price to expire below 440. And then we talked about 442 on the other side. 442, I believe, is what we came up with over there. But 442 doesn't look like it's only paying $3. Today's dinero. That's not enough. Again, you're going to pay $1.30 in fees. So again, we don't trade for trading sake. We trade for money. So if this isn't going to pay out better, then we'll just leave that alone. Looks like the other side gave us $10, right? So we leave this 442. 441, I believe, was too close when we looked at our strike. The 441, the delta has come down to about 36, but that's still higher than I want to be. 37 delta is saying 37% chance it'll get here. 63, 64% chance it won't. Some people are cool with 65%. You know, 65% in some classes is passing. I like to be a little bit, if it needs to be below 30 for me. I don't feel comfortable until it's below 30. There's other things I can look at. 441 probably is going to be the strike is probably going to be okay, but that's not what I want to teach you in your first time out the gate, because there's other things I can see on here that tell me it'll probably be okay. Unless you just, some people are a little more risk averse than others, and they trade a lot closer to the fire. We have a quiz. Go and check out tradingstrategyforyou.com. It helps you to look at which trading strategy suits you as an individual better. Because sometimes people have a risk averse. Some different strategies work better for them than others. So in our monitor tab, we can come here and look at our XSP trade and see that we've got 439, 440 as our put credit spread, meaning we don't want the price to end below 440. We took in $10 to do that. $10 received with $100 leverage is a 10% return today. 10% ROC in one day. Those are good returns. People may look at it and say, oh, that's only $10. You're right. It is only $10, but it's $10 today, $10 tomorrow, $10 next day. And if you want more, let's say you wanted to make $40 or $50, that means just you do more contracts. If you pick a strike you like, you find a strike you like, and it pays $10, you want more than that, then do multiple contracts. 2 contracts, $20. 3 contracts, $30. Just know Every contract you're doing is also adding in more collateral, adding on more collateral. Okay. Arlissa Pinkleton, educator to trader, talked about options today, calls, puts, right? Buying and selling. We looked at XSP. Please go check out that video that you see on the screen there if you'd like to see more about that, and subscribe to the channel. We got the membership going. You can join us there anytime you're ready. You join the membership anytime you want. Great community of traders. Listen, the people are phenomenal. And I'm not saying that just because they hang out with me, but they're really just great people. All right. The SPX playbook. That playbook is the book that we use to trade this strategy. The strategy, it includes all the different pieces of it, and it's for SPX, but it can be tailored down to XSP. That is $27 at spxplaybook.com. You can go over there, .com.net. Both of them work to take you to the same place. You can get your book and go through the playbook. It comes with videos. Well, take that back. You have to pay a little bit extra if you want videos, not a whole lot. I think it's like $13 more if you want to get videos to go with the SPX strategy. But that's what we use every afternoon in order to make money in this community. When you see me post about that, that's how we're doing it. We're using the SPX strategy every single day. Join me on Facebook. We got a Facebook group over there. You can find me there. You can find me on Instagram, on TikTok, basically in all the places. We do two things in this community. Two things. We stay green and we get this money.